Have you ever looked at a seemingly successful business, like maybe a coffee shop on a really busy corner, and wondered why someone else trying the exact same thing just down the street completely and utterly fails?
Oh, all the time. It's fascinating.
Right. I mean, they have the same foot traffic, the same basic product, but one has a line out the door and the other has a going out of business sign. Well, welcome to today's deep dive. We are tackling that exact phenomenon, but we're looking at it through the highly specific, real-world lens of the Katoomba Airbnb market.
Yeah, and it's a brilliant microcosm to explore, really. Because when you look at highly desirable areas like Katoomba and the Blue Mountains, the market acts as this pressure cooker for broader business competition.
Definitely.
The numbers we're unpacking today from April 2026, they reveal the underlying mechanics of why certain properties thrive, while others, which, look completely identical on the surface, just slowly lose traction. We're really looking at what separates a passive asset from a high-performing business.
And the mission for this deep dive is to decode what those numbers are actually telling us. We really want to move beyond gut feelings here. The era where you could just buy a nice house, put some decent furniture in it, and watch the money roll in, that's completely dead.
Oh, yeah, long gone.
So today we're going to walk through why set and forget property management fails and how incredibly small strategic tweaks compound into massive revenue gains. And I want to say right up front, even if you don't own property in the Blue Mountains, the underlying psychology of competition and, well, dynamic pricing that we're about to cover applies to almost any business where you are fighting for a consumer's attention.
The lessons are entirely universal. I mean, when you analyze a market that is functioning at a very high level, the margins for error just evaporate.
You're forced to optimize.
Exactly. You optimize or you're forced out. And to understand why that happens, we really have to look at the macro view of Katoomba right now. The baseline numbers, well, they look like an absolute gold mine.
Let's hear them.
So in April 2026, we're tracking 164 active listings in the suburb. The median nightly rate is a very healthy $407. The average rating across the board is incredibly high at 4.79. And the premium band of properties, like the top tier, is sitting around $572 per night.
Okay, let's unpack that because on paper, it sounds like everyone is winning, right?
Okay.
A $407 median rate and a 4.79 average rating across 164 properties.
Mm-hmm.
If I'm an investor looking at those numbers, I'm thinking this is the easiest money in the world.
And that right there is the illusion. Those baseline averages are hiding a much fiercer reality. What that 4.79 average rating tells you is not that the market is easy.
No.
Not at all. It tells you that the barrier to entry just to be considered acceptable is punishingly high. We have to draw a distinction here between a supply-constrained market and a competition-driven market.
Right. Okay. How do those differ?
Well, if a market is supply-constrained, you can have a mediocre product, terrible photos, spotty communication, and you'll still sell out because people are just desperate for a bed.
Right. They just need anywhere to sleep.
Exactly. But Katoomba is not supply-constrained. With 164 active listings, we are looking at an entirely competition-driven environment. There's enough demand, sure, but there are also enough listings that performance is no longer automatic. You can't just throw up some photos and expect a windfall.
So there's plenty of demand, but because there's so many high-quality options, it's just really tough. It sounds like grading on a curve in an honors class.
Oh, that's a great way to put it.
Yeah, like when the average rating is a 4.79, being good actually means you're just average. You aren't just competing on having a nice house anymore. You're competing on these tiny, invisible margins.
The honors class analogy captures it perfectly. The baseline expectation from a guest is near perfection. Almost every host in Katoomba is cleaning the property well, communicating properly, and, providing a great basic experience.
So everyone gets an A for effort.
Pretty much. So the market fundamentally shifts. It stops being about the physical real estate and starts being about positioning, marketing, and dynamic adaptation. Because of the sheer visibility of the Blue Mountains, you're competing heavily on first impressions, pricing accuracy, review depth, listing quality, and guest confidence.
Oh.
And this explains why two identical properties on the exact same street can have wildly different revenue numbers. Because one host understands that game and the other doesn't.
Let's dig into how that actually happens, though. If two houses have the same floor plan, the same mountain view, and they both have that perfect 4.79 rating, what is the actual mechanism separating the winner from loser?
It comes down to what I call the silent revenue killers. Because of this high visibility, what we consistently see in Katoomba are listings that just blend in instead of standing out, or pricing that completely ignores demand.
Can you give an example of how that plays out for a guest?
Yeah, let's walk through a hypothetical guest journey. A guest is scrolling on their phone for a weekend getaway. They see 15 listings in Katoomba that all cost around $400 a night. Many of those listings just blend together.
Oh, look the same.
Exactly. They might be stunning homes, but the hero photo, like the very first image the guest sees, is a wide shot of a living room that looks exactly like the 14 other living rooms. So the host loses the click right there.
Right.
Then you have weak conversion rates. Maybe the guest does click, but the title doesn't highlight the specific amenity they care about. Or the photos aren't arranged to tell a story about the experience, so they bounce and book the neighbor's house instead. And then there's operational inconsistency that slowly damages those crucial reviews.
But wait, I have to ask, do those kinds of small aesthetic choices really translate to thousands of dollars? I mean, it feels a bit like splitting hairs. If the house is nice, won't it eventually get booked anyway?
It will get booked, but it will get booked last. And that is where the damage happens. These issues do not crash your performance overnight. It's not this catastrophic failure where you wake up and your calendar is entirely empty.
Okay.
Instead, they quietly cap your revenue over time. Imagine an owner who checks their calendar, sees they have 70% occupancy, and thinks they are just crushing it. What they don't realize is that because their listing didn't convert as well as their competitors, they only secured bookings after the premium properties sold out.
Oh, I see.
Or even worse, they secured those bookings by lowering their price out of panic at the last minute.
So it's not a sudden cliff you fall off. It's more like a leaky tire. You can still drive on it. The car still moves forward, so you don't even notice it's flat until you look at your year-end revenue and wonder why your neighbor made 20% more than you did.
A leaky tire is the perfect visualization for this. You're spending the exact same amount of energy, paying the same mortgage, managing the same cleaning teams, but you are getting fundamentally less traction.
Yeah, that makes a lot of sense.
And in a highly competitive market, that lost traction really compounds. If your neighbor makes 20% more revenue, well, they have more capital to reinvest in better amenities. Those amenities get them better reviews, which pushes their listing higher in the search algorithm. The rich get richer, and the leaky tire eventually goes completely flat.
That compounding effect is huge. And it leads us into a really fascinating part of the Katoomba data, because patching that leaky tire looks very different depending on what kind of car you're driving, so to speak.
Absolutely. One size definitely does not fit all here.
Right. The numbers reveal a very clear pricing staircase based on property size, and the strategies for managing them are just worlds apart. We're really looking at a bedroom battlefield here.
Granular data is where you find the real leverage. The staircase we're seeing in the April 2026 data goes like this. One-bedroom properties sit around $212 a night. Two bedrooms jump to roughly $317. Three bedrooms hit around $423. And four bedrooms leap all the way up to about $616 a night. Now, on a superficial level, that looks like logical math. A bigger house costs more money. But the underlying behavioral mechanics of these segments require completely different management philosophies.
Let's start with the smaller properties then, the one-bedrooms. The data highlights that they have the highest review depth in the entire market, hovering around 113 reviews on average.
Yeah, and that review depth is a massive defensive moat. Think about it. One-bedroom properties appeal mostly to couples or solo travelers. They have very high turnover and much shorter stays, which means they accumulate reviews much faster than larger homes.
Right, because you have more guests coming through in a given month.
Exactly. And because of that, their visibility is incredibly stable. Their core strategy relies almost entirely on history and operational consistency. They don't have massive pricing power. I mean, there is a hard ceiling to what a couple is willing to pay for a single bedroom. But those 113 reviews create a profound sense of guest confidence.
I want to challenge that slightly, though. Does a high number of reviews actually guarantee a booking? Like, what stops a brand new one-bedroom listing with just, say, 5 perfect reviews and slightly lower pricing from undercutting that established property and stealing their lunch?
It's a fair question, but it really comes down to the psychology of risk. If a couple is booking an anniversary trip to the Blue Mountains, the perceived risk of a bad experience completely ruins the value of saving $20 a night.
Oh, yeah, you don't want to mess up an anniversary.
Right. A listing with 5 reviews is still an unknown quantity. A listing with 113 glowing reviews is a guaranteed outcome. In the one-bedroom market, consistency is the actual product you are selling.
That makes total sense. But when we shift our focus to the larger properties, the 3- and 4-bedroom homes, That defensive, consistency-first strategy seems to completely fall apart, doesn't it?
It does. Once you move into 3 and 4 bedroom homes, the pricing spread becomes incredibly wide, and that premium band of $572 and above becomes highly relevant. The game completely changes because the guest profile changes.
Right, you aren't booking couples anymore.
Exactly. A 4 bedroom home caters to families or large groups. They book less frequently, but they stay longer. And crucially, they are splitting the cost among multiple adults.
Oh, that's a great point. Splitting $600 four ways feels a lot cheaper than paying $200 by yourself.
Exactly. The gap between an okay price and a premium price for a 4 bedroom home is vast. If you try to manage a 4 bedroom house with the same defensive set and forget mentality as a 1 bedroom, using static pricing, you are literally leaving thousands of dollars on the table during peak demand periods.
Here's where it gets really interesting. It's like the difference between a reliable savings account and the stock market.
I like that.
Yeah, the one bedrooms are your slow and steady compound interest built on hoarding reviews. But those four bedrooms require active day trading with the price to hit that premium band when the market conditions are right.
That is a brilliant way to conceptualize it. A 4 bedroom house in Katoomba is a volatile asset. The demand spikes aggressively based on holidays, local festivals, and seasons. Your pricing strategy must reflect that volatility.
Makes sense.
If you just set your 4 bedroom at $616 all year round, well, you're going to be completely empty when demand is low, and you'll be vastly underpriced when a major holiday weekend rolls around.
But if four-bedroom homes require this aggressive day trading, how does a host actually execute that? Because if I'm looking at my calendar trying to guess what a random weekend in 3 months is worth, seems almost impossible.
It is impossible if you're just guessing.
Right. And this brings us directly into one of the most glaring traps in the data, the massive discrepancy between Tuesday and Saturday.
Yeah, the calendar trap. One of the biggest signals in the April data is this. Katoomba is not a flat pricing market. It never has been. There is a massive and clear difference between weekend demand and midweek demand.
Okay, so walk me through the economics of that.
Sure. When we talk about dynamic demand in economics, we're talking about the reality that the value of perishable inventory changes based on external factors. An unbooked night in a short-term rental is exactly like an empty seat on a departing flight. Once the day passes, that revenue opportunity is gone forever.
Right, you can't sell yesterday.
Precisely. So if a host is using a single static nightly rate across the whole week, they are guaranteeing two catastrophic inefficiencies. Let's look at the mechanics of it. By setting one average price, you are going to be underpriced on the weekends. This means you're losing your profit margin.
Okay.
Simultaneously, you're going to be overpriced midweek, meaning you are losing your occupancy. By setting one static price, you are punishing yourself twice a week. You give away money on Saturday by being too cheap, and you sit completely empty on Tuesday by being too expensive.
Wow, so the end result is lower overall occupancy and lower overall revenue.
Exactly. It's the definition of a lose-lose strategy.
Let me play devil's advocate for a second, though. I put my consumer hat on, and I think, well, doesn't constantly changing the price frustrate potential guests? Like, if I look at a listing on a Tuesday and it's $300, and I check back on a Thursday to book it for the weekend and suddenly it's $500, I might feel a bit cheated.
I get that, but we're actually dealing with entirely distinct markets here. A guest booking a midweek stay in Katoomba is often a retiree, a digital nomad, or someone traveling for work.
Okay, so they have different priorities.
Right. Their price sensitivity is very high, and their schedule is super flexible. A guest booking a Saturday night is a couple coming up from Sydney for a romantic getaway, or a group attending a wedding. Their primary driver is the experience and securing specific dates.
So their budget is entirely different.
Completely different. You aren't alienating one guest by changing the price. You are catering to two distinct markets with the appropriate price for each. A static price in a dynamic market is just a guaranteed formula for inefficiency.
Okay, so if human gut feeling and static pricing fail so spectacularly in this environment, how does anyone actually manage this without sitting at a computer 24/7? We know that blending in with generic photos is a slow death. We know that treating a four-bedroom house like a one-bedroom apartment leaves thousands on the table.
Yeah, it's a lot to manage manually.
So how do you practically solve these problems? The answer seems to lie in treating the listing not as a passive billboard, but as a dynamic engine. And this is where the methodology of hosting provides a really fascinating blueprint for success.
Exactly. When you synthesize all these market forces, Katoomba heavily rewards three things: precision pricing, strong listing conversion, and highly consistent operations. And on the flip side, it ruthlessly punishes generic listings, static pricing, and inconsistent guest experiences.
Which makes total sense based on the numbers.
Right. So hosting built a system specifically tailored to exploit these dynamics in this environment. They don't treat Airbnb like a passive listing platform. They treat it as a performance system.
Let's break down what a performance system actually means, because, that can sound a bit like a corporate buzzword. What are the actual mechanics of what they are doing differently?
Sure. Think of it this way. A passive platform means you put a billboard up on the highway and just hope people call the number. A performance system means you are actively tracking who drives by, what time they drive by, adjusting the message on the billboard in real time, and measuring exactly how many people exit the highway.
That's a great analogy.
Thanks. So, hosting tackles this with three main pillars. First, they deploy a revenue engine. And this isn't just dropping the price $20 on a Wednesday. The engine scrapes market data, measures booking pace, analyzes competitor occupancy, and adjusts pricing dynamically around demand spikes.
Okay, so it's actively seeking out that premium band we talked about.
Exactly. It's doing the day trading for you, ensuring you aren't leaving money on the table for that Saturday wedding crowd, but still capturing the digital nomad on a Tuesday.
What's the second pillar?
The second pillar is listing optimization that is ruthlessly focused on conversion rates. This means they don't just use pretty photos. They test hero images. They update captions based on the season, highlighting the fireplace in winter and the outdoor deck in summer.
Oh, wow, so it's constantly evolving.
Yeah, they structure the title to capture search intent. The goal is to ensure that when a guest looks at the listing, they actually book it, rather than clicking away to one of the other 163 options.
And the third pillar?
The third pillar is a rigid operations and cleaning system designed specifically to protect those reviews over time. It builds that defensive moat we talked about earlier.
So what this all means for you, the listener, is that the gut feel era of real estate investment is completely over. What hosting is doing is treating an Airbnb listing the exact same way a sophisticated tech company treats a high-converting landing page on a website.
That's exactly what it is.
You tweak the headline, you A/B test the photos, you systemize the delivery, and you rely entirely on data to tell you what is working. Small, calculated improvements compound into major revenue differences. Those relying on gut feel are just losing to data.
It is the professionalization of the short-term rental market. When you implement a revenue engine to fix the weekend versus weekday trap, optimize for conversion to beat the competition, and systemize your cleaning to rigidly maintain that 4.79 average, you transition from being a passive owner to an active market leader.
You really do.
The compounding effect works in both directions. You want it working for your revenue, not against it. This really matters most for owners who feel like their property should be doing better, or listings that look good but just aren't converting.
Or hosts who are just exhausted constantly adjusting things manually. Well, this has been incredibly illuminating. Whether you own a property in Katoomba, whether you're looking to invest in the short-term rental market somewhere else, or honestly, if you just want to apply data-driven competitive thinking to your own business, the lesson is crystal clear. Relying on guesswork leaves your performance and your money on the table.
Absolutely. If you do not understand the specific data dynamics of your market, you are flying blind in a very crowded airspace. You need to know your real baseline, not just the one you hope is true.
And these kinds of detailed insights, like the April 2026 Katoomba breakdown we explored today, are published precisely so owners can see exactly what is happening in their suburb without having to guess.
Right, it takes the emotion out of it entirely.
Exactly. So if you are an owner and you want a clearer picture of exactly where your property sits in this landscape, you can reach out to Hosting for a revenue estimate or explore their full April report. It is the first step in moving from a leaky tire to a true performance system.
It really is.
We started today talking about two businesses on the same street, one failing, one succeeding. We've seen how a set-and-forget mentality, how treating a dynamic market like a static one, quietly leaks thousands of dollars over time. It makes you wonder, beyond real estate, where else in your life or your business are you relying on a static price in a dynamic world, quietly capping your own potential without even realizing the tire is flat? Something to think about. Until next time.